Oh, we're recording. Never mind.
Well, hopefully we're recording something. Okay. Slide 50. So we're about 33% of the way through. Proprietary funds, capital asset impairments. This one gets fairly complex, and you really have to go back to GASB 42 and figure out for the situation that you are experiencing how to do the accounting. And if somebody wants to volunteer to do a presentation on 42, that would probably be a good thing. Doesn't happen a lot, but recently it was the headwaters apartment buildings, the roof, and pretty much gave way, and we had to evacuate all the apartments, and we wrote off part of the building, and then went in and did the mitigation to get everything back to where it should have been and move people back in. So bond refunding, current and advance. So we don't do a lot of advance refundings, mostly current ones. And basically what this means is that most of our bonds are sold with a 20-year life. And they have a clause in them that you cannot refund them until 50% of the life of the bond, so 10 years. So Melina may have noticed that the refundings that pop up tend to be from 10 years ago. We're taking 10-year-old bonds and refunding them, and that's why, because there is a clause in the contract that says that we can't pay off the bonds or defease the bonds until the 10-year mark. So once we get to the 10-year mark, we can sell refunding bonds and then pay off all the existing bondholders. Advanced refunding would be if we did it at like the 5-year mark. And we couldn't pay off the old bonds that hadn't come due yet. But we can put them in trust along with the money from the refunding. And then that pays off the old bonds. And then we are just paying off the new bonds. And that's where you have a defeasance. Technically, the bonds are still outstanding, and we technically owe that we have established a trust fund that has enough money to pay the bond and interest payments for the life of the remaining bonds.
Is that the in substance defeasance?
Yeah, I think that's what that one is called.
Okay.
Compensated absences. That's a statement that for the new standard is coming out, if it hasn't already. And that's going to change our liability dramatically. For instance, right now, we're basically recording a liability for what we would have to pay out if everybody retired on June 30th. But under the new standard, we're going to have to record a liability for everything that is owed. So as an example, management leave can't be paid off when a person retires. So we aren't including it in the current liability. But once a new standard comes in, then we will have to record the liability for management leave. System development charges we talked about a little bit. So that's parks, and Vaught, BES, and water. So whenever new construction happens, people are charged system development charges that then goes to those 4 bureaus. Developer contributions, we've talked about that before. It's where like somebody's putting in a subdivision and puts in sewer and water mains and then gives them to us when the project is done. Regulated industries, that would be our BES and water. And for us, the regulatory agency is the city council. But in many states, cities have to go through the whatever state regulatory agency there is. And here, like PG&E and Northwest Natural, will have to go through that state agency, and they review the rates that people that they can charge and decide what assets that they can record and that sort of stuff. So,
Ron, does GASB dictate it that we have to have those separate from other capital assets?
yep, yeah,
Did you say yes?
yes. So, see if I can find my actor. So, if you look at our last year's statements, we come down to a total of capital assets net of accumulated depreciation. And then right below that, we have regulatory assets, construction in progress, and then regulatory assets net of accumulated depreciation.
Yeah, no, I just didn't know if that was required.
Yeah, because it's not a capital asset under the definitions of GASB. It's just something that our regulatory agency required us to do, and so we did it. And water. Now, water has worked with their wholesale clients to basically classify them as capital assets because the wholesale rates are partially tied to capital assets. And I don't know exactly how the formula works, but I know Water Bureau.
They get charged on the depreciation, yeah. On
Yeah.
certain assets that they use. Yep.
So water made a big deal about grading regulatory assets when GASB did away with capitalized interest. And so for us, regulatory asset is capitalized interest. And it's just done for water. I think BES didn't want to mess around with it. So for the proprietary statements, we got current assets, non-current, deferred outflows, current liabilities, non-current liabilities, deferred inflows, and net position net of capital assets, restricted, unrestricted. And then there's a reconciliation to the business type activities. Now, I don't know, Kevin may not have registered this yet. I actually was aware of it, but GFOA now has a new requirement for a certificate of achievement. So we're going to have to submit a separate schedule from now on that shows how we calculated net investment in capital assets. So basically what that number is our capital assets minus accumulated depreciation minus any debt that was issued to pay for capital assets. And then if, as it is not unusual, we will have cash that's left over and we haven't spent yet. So you have to reduce the capital debt outstanding by any proceeds that are unspent. Anyway, that's kind of what that number is, and I think GASB every year tries to calculate it on their own, and they just gave up, and now they're just going to make everybody submit a schedule showing how they came up with that number. Now for us, we go a little bit further, and we break out restricted assets and liabilities. And then non-current assets, it's buried in GASB 62. But this one tripped me up. And that anything, now I had always thought that cash would just be current. Because it's cash. But the reality is any cash that is going to be converted into a non-current asset, which I mean, so that's money that you're going to buy capital assets with, or any cash set aside to pay long-term debt. That cash becomes non-current cash. So it's one of those little things that I wasn't aware of, but once GASB 62 came online, it became clear because it was buried in GASB 62. So that was an interesting one to me, anyway. I'm a kind of a nerd. Proprietary fund financial statements. So we got operating revenues, operating expenses, non-operating revenues and expenses, transfers, capital contributions, extraordinary special items, and change in accounting, and then a reconciliation to the change in net position for business type activities. So there's a new standard coming out that's going to redefine extraordinary special items and changes in accounting. So we'll have to look at that. It doesn't happen every year, but changes in accounting happen on a fairly regular basis. Special items happens now and then. The last big one I can remember was water had started to build a filtration system, and then DEQ changed their opinion about that filtration system. So we just wrote the thing off, and that was a special item. So a special item has to be unusual, and it has to be under the control of management. And that was a decision management made. So, and where extraordinary is something that just uncontrollable. For us, a hurricane, for example, would be extraordinary. For Florida, it's not extraordinary.
What about like for fraud? Would that be an extraordinary?
Potentially, if it was an extraordinary fraud. But not for 1.5 million, it's not material enough, but maybe if it was $100 million fraud.
Yeah. And that kind of worries me, because over the next 3 weeks, we're going to be paying several $100 million worth of bonds and interest payments through wires. So anyway, now the one that I kind of didn't agree with GASB about is they decided that COVID was not an extraordinary event, because they basically came down, well, it's just a cold. That happens all the time. So anyway, I didn't agree with that particular one, but And I think operating and non-operating, sounds like Melina has talked about a couple of times about issues with lease revenues and expenses, whether they're operating or non-operating. So anyway, case flows, and we can only have the ones that were defined by, I think it was GASB 9, defined that you could have operating activities, non-capital, capital and related financing and investing. And there has to then be a reconciliation of operating income to net cash.
Can you give an example of a non-capital financing activity? Because I don't see that very often on our statements. Or at all, maybe.
Yeah, I can't think of anything right offhand. I mean, would there refunding? I don't know. I'd have to.
I can look too.
Look and
Well,
see.
there's some interesting differences between what the state law says is required to be used for GO bond proceeds and then what the capitalization rules are. So like some common examples are like if a school buys a whole bunch of computers, we wouldn't typically capitalize that today. I mean, well, maybe in a year, but today we wouldn't typically capitalize that, but you could use that for bond proceeds. And another example was police cars that were under a particular entity's capitalization threshold could still be used for bond proceeds.
Well, statements, we have transfers in, transfers out, and payments from internal loans. So that looks like what we have normally. And that kind of makes sense because a transfer in and transfer out under current guidance, that's just basically a gift. We're just giving the money. Now, when we move to the new reporting model for governmental funds, we'll have to segregate transfers in and transfers out based on whether they're capital related or operating related. But I don't think we have to make any changes for proprietary funds for that one. Current cash, or current asset cash and other assets expected to be realized in cash within 1 year and consumed within a year. Oh, like inventory. Restricted cash, if it is to be used to pay current liabilities, classified as current, otherwise not current. For example, like I was talking about bond proceeds that will be used to build capital assets. Current liabilities, obligations whose liquidation is reasonably expected within the existing resources, classified as current. And then pension and other post-employment benefits are non-current. Now we do ask the bureaus that have outstanding proceeds from bonds that are going to be used for capital assets to kind of figure out how much of that cash is going to be used to pay current liabilities. So if they've got a construction project underway and a portion of it is in accounts payable, we go ahead and take some of that non-current cash and move it up to current to kind of help our current ratio to make it not look bad, since we've already got the liability recorded that money is going to be used to pay. Then we can justify moving it up to a current asset. So it makes our us look a little bit better to the bond analyst. On financial statements, there currently isn't any authoritative guidance as to what is current or what is operating and non-operating. And that will change with that new reporting model, because it's going to specify what can be non-operating. Goal is to demonstrate that the fund is able to recoup from its customers the cost of providing services. Now, for us, we've got multiple budgetary funds that are considered consolidated into a single gap fund, and we have to eliminate all the transfers back and forth between those. So, for instance, BES and water both have an operating fund, a capital project fund, a debt fund, and I think seems like there's one other fund for BES. But anyway, money is moving back and forth all year long in between those budgetary funds as transfers in and out, and we have to get rid of all that intra-fund activity for the gap basis financial statements. And then, oh, this is a good one. We should talk about this one a little bit more. Evaluate whether transfers are actually transfers or are an exchange transaction. So our budget office, although they're really wonderful at what they do, don't always understand the difference between exchange transactions and non-exchange transactions. And so they sometimes record things as non-exchange when they really are exchange. And then we have to go in and analyze and make a determination for gap basis financial statements. We can't change the budget, but we can change the gap basis financial statements. So one of the obvious ones is that they consider the general fund overhead as a cash transfer in between funds. But in reality, all the funds are buying services from general fund. So we reclassify that as revenue in the general fund and expenditures in the all the funds that give them give money to the general fund. Now, over the last 3 weeks, I've been dealing with something that Parks has done, and I'm not particularly happy with it, but it has happened, and we will figure out how to change the gap basis when the accounting to fix it. So basically, what has happened is this year we have a Parks levy fund, and it has started collecting tax revenues. Parks said it was too much work to split up expenditures and charge part of it to the general fund and part of it to the levy fund. So they are not charging any expenditures to the levy fund. And so what they have opted to do is do a cash transfer from the levy fund to the general fund. And they have stated in their emails and in meetings that their intent was that this was going to be a reimbursement of expenditures that were made by the general fund, by the levy. So when we do the general fund and do the Parks levy fund for gap purposes, we're going to have to reclassify those transfers and expenditures in the levy fund and revenues in the general fund. And whoever does the proprietary funds also has to go through this, because there is money that moves back and forth. oftentimes for the general fund, like water. That is really the general fund buying something from water. So anyway, that's part of your job when you're putting together funds, is to analyze those transfers and figure out if any of them are non-exchange. So anyway, something fun to do. And I need to find another cough drop. I'm not used to talking this much.
Ron, on the revenue recognition piece, I feel like I'm still bugged by the fact that we never do the reimbursement version. So even like what you were saying about general fund services being revenue generating, for me, they're not, it's cost reimbursement. And the same with, particularly the example you just gave with the parks levy fund. I mean, that completely to me, I mean, it's not like the general fund is doing services for the parks levy fund. It's like they're just parking expenditures in the general fund that belong in the levy fund. So how do we call that revenue generating?
Yeah. I argued for, let's just move the expenditures to the levy fund. We can
But
do
even
it on
if they
a monthly
don't do
basis.
that, why can't we just do that? Why can't we do cost, so these are transfers, right? So why can't we just reclass the, credit side as to offset expenditures and at the functional level?
Yeah, well, sometimes it's politically expedient to just.
Yeah, I thought so. Okay, it's okay if that's the answer. I can handle that. As long as we're on the theoretical same page, that it's not revenue generating, damn it.
Yeah, it should be. We should be transferring expenditures to the levy fund, not transferring cash to the general fund. But we can fix it. We have presentation accounts for GAAP purposes we can use to fix it. So, proprietary fund financial statements. Like I got the wrong word. We have revenue by major source, net of discounts and allowances. Expenses by use, so personnel.
Wait, Ron, are you telling me there's no bad debt expense in government? And that the bad debt expense offsets revenue?
Yep.
That one's really big for me. Sorry, I had to make a big deal out of it. So many of you for-profit accountants come here and look for bad debt, and then you try to put it in the expenditures, and I go, no. That offsets revenue here, people.
Yeah, this is for proprietary funds. When we're over in the governmental funds, it'll show up in the functional costs, like housing. We're talking about writing off that loan, and so that'll get written off to 529007, the bad debt expense, and it'll show up in the financial statements as housing or community development. I think it's what it would be in. And then we got regulatory accounting, water bureaus continuing to report capitalized interest. And then Water Bureau classifies their rental income as non-operating income. I was trying to remember the guy's name, Eric.
Yep, Eric. Oh gosh, hold on. Oh, I wanted to say Hofeld, but that's not right, is it? Eric Hofeld?
I think so. Anyway, he would always bring us these really colorful spreadsheets. Print them out, and they'd be in all bright colors, and I can remember him talking, and we finally just said, okay, if you want it to be non-operating, we'll call it non-operating. Fiduciary funds. This is where the government is functioning as a trustee or a custodian, and that assets are held in legally established trust fund, which for us is FPD&R. And they're the ones that are held outside of a trust for the benefit of others. For instance, taxes we collect for Metro and the county, those are custodial funds. So, fiduciary funds, pension OPEB. So, this is out of, I think, GASB 67, and it defines what a trust fund is for pensions and OPEB. So there's a similar statement in paragraph 4 of GASB 74. So 67, 68, 67 covers how you do reporting for a pension fund itself. 68 tells us how the city is going to report pensions. Similarly, 74, if we had a pension or an OPEB trust fund, that would be how we would report that. And 75 tells us how the city reports OPEB costs. So this is the basic definition. Statement establishes for defined benefit pensions and defined contribution pensions provided to employees of state and local employers through pension plans that are administered through trusts or equivalent arrangements, hereafter jointly referred to as trusts. So the contributions from the employers and non-employer contributing entities. So that would be the city donating to state and state PERS. No, non-employer contributing. So that would be if somebody else helped us to make our payments. So like in Montana, the cities and counties pay a rate into the state PERS, and then the state general fund kicks in a little bit of money to help the employers out. Pension plan assets are dedicated to providing the pensions to plan members in accordance with benefit terms. Pension plan assets are legally protected from the creditors of employers. So basically, that is not our money. It belongs to the beneficiaries. In our case, the sworn officers of police and fire, who are under the. It's kind of interesting because it's everybody that was hired up to, I think, 2006 is actually covered by the FPD&R pension, and they receive a pension payment from them. But anybody hired after that, so I think starting 1107, they're in PERS just like we are. But FPD&R pays PERS for the premiums on those officers. So FPD&R is a kind of a combination hybrid type thing. And as we talked about at one point, although the taxes, we show the receivable and the tax revenues in FPD&R, technically that money belongs to the general fund. So for GAAP basis financial statements, we record those receivables and tax revenues in the general fund, and then show a payment from the general fund to FPD&R as an employer contribution. So fiduciary funds treat trusts are the ones that meet the definition of paragraph 4 for 68 and 75. We control the assets and we use the assets on the behalf of beneficiaries. Custodial funds assets are controlled by the government. Money isn't derived from our own source revenues. And it could be a pass-through grant with no administrative duties. One or more of the following characteristics: not administered through a trust for the benefit of others, and government doesn't have administrative or direct financial involvement for the benefit of others, not part of the reporting entity. So the biggest balances here are the money we collect for the county and metro. At the end of April, we had $250 million sitting in that custodial fund that we needed to pay to the county and metro. And Treasury had to scramble to pull together that much money to make the payment in May. So fiduciary funds own source revenue, so generated by the government itself. And we use economic resources measurement focus and accrual basis of accounting. Pensions recognize liabilities when benefits, refunds, and administrative costs are due. Custodial funds recognize liabilities when the fund is compelled to disperse. And other types of trust funds are investment trust funds and private purpose trust funds. So, like a county will have a whole bunch of cash, oftentimes that belongs to other people, and they will sometimes set up an investment trust fund. I don't think it's true here, but in Montana, the county is the treasurer for the school districts. So the school districts don't have a bank account of their own. So everything gets deposited, all their revenues get deposited into a county bank account. And then when they write checks, it's drawn against the county bank account. So that the counties end up with a whole lot of cash that belongs to all the school districts in the county. And they usually will create an investment trust fund so that they're allocating out the interest that they earn to all of those entities that are in their custodial. So that's something that we have to deal with. And private purpose trust funds, we don't have anything like that at the moment. And we could conceivably have something in the future. So chapter 17 of fiduciary fund financial statements. We've got statement of net position. We got changes in net position. Unlike proprietary or enterprise and governmental funds, there are no major funds. There are no cash flow statements. And we don't classify assets and liabilities as current and non-current. And instead of revenues and expenses, we have inflows and outflows and no transfers. And once we get to the new reporting model, governmental funds will just have inflows and outflows. That's a concept that GASB's been moving towards for quite a while, and that's why we have deferred inflows and deferred outflows. It's just part of that whole concept that they're switching over from revenues and expenses to inflows and outflows. And no transfers, and that's an entry that we have to make every year because actually FPDNR makes a contribution to the the Hobbs debt service fund. And it seems like there's something else that they do a transfer for. So in the FPD&R statements, we have to reclassify the transfers out as administrative costs. And then we have to get rid of them and reclassify them as revenues over in the governmental funds where the money went to. And that makes sense because otherwise in your government-wide financial statements, your transfers in and transfers out would not equal because part of the transfer in would be as a transfer out sitting over in FPD&R, and that doesn't get consolidated into the government-wide financial statements.
Affect the tenants too.
Guess I should look back.
I don't think he heard you, Kevin.
I don't think I missed anything. So converting and consolidating fund data. Government-wide statements, converting governmental fund data to economic resource and governmental and measurement focus on accrual accounting, not actual.
Bias there, Ron?
Yeah.
Actual accounting.
We're adding capital assets, debt, pension, OPEB, compensated absences, accrued interest, and removing capital outlay, debt proceeds, debt principal payments, eliminate inter-fund, and consolidate the ISF funds after eliminating the interagency activity, which is the look-back adjustment. We use out of Schedule 115 is where we do the government wides. And we're also eliminating any indirect costs. So let's see. That's probably not. So anyway, where that took me to was basically out of Schedule 115 with all the files. So let's not worry about doing that today. Does this one take us to? I don't know if you see that.
Yep.
Yes, yeah.
Okay, so that's our government-wide financial statement. So we're consolidating all the governmental funds and internal service funds into governmental activities and all the enterprise funds into business type activities.
I'm sorry, I had to go to the restroom. Did you talk about that choice, the choice you have to make about internal service funds?
Yeah, we'll talk about that another time. And this is a fun puzzle, and then this is the operating statement. A lot of people do not like the layout. I personally do. But basically, what you've got a column is with all your expenses, and charges for services, operating, and capital grant. And this tells you where your property taxes go, because your property taxes are down here, along with lodging and miscellaneous taxes. So you can see that $806,000 of your property taxes and other types of taxes went to public safety, and 79 million went to parks, and 242 million went to community development. So I find it interesting to lay it out this way. Now, I posted a link to this series on YouTube, on my LinkedIn, and asked for ideas, things that people wanted to hear about. And one of them was that conversion from governmental funds and internal service to governmental activities. So at some point, I will put together a training that goes through all that in detail, because it's something that, I mean, to me, it's interesting, and it just I like number puzzles, and this is a really fun number puzzle to play with. So anyway, we will go back through that. Are we back to the slides?
Yep.
So we got a statement of net position, statement of activities, showing where the tax money went. There is no cash flow. And let's see, we talked about governmental funds and ISF being governmental activities, enterprise and business type. And then we have to present the discretely presented component units in a separate column next to that. And for us, that's cost report. And then capital assets are presented net of accumulated depreciation. So rather than having buildings and then total buildings, and then another line with accumulated depreciation buildings, we net those two together. And what you're seeing in the capital assets section of the government wide, it's just the net amount of buildings. And that's different than the proprietary funds, where we list each of the capital asset types and then each of the line items for accumulated depreciation, which is probably a good thing. It's, if you notice, the asset page of the net statement of net position is, there isn't much room to add anything more. And this year we're going to be adding leases onto there, so we're getting to have too many different types of categories. Somehow we're going to have to use a smaller font or something. Government-wide statements, statement of activities by functional expense, so like public safety, community development, parks, environmental services, water. Depreciation is included in the functional expense. So in the proprietary statements, depreciation is broken out as a separate expense type, where here it's just buried in with a functional expense category. For governmental funds, we break out the interest expense separately for governmental activities, but for business type activities, it's buried in with a functional expense. And I'm not sure why they did that differently, but. And then program revenues are broken out by service charges, capital grants, operating grants, and then general revenue, such as taxes, are presented at the bottom. Now this is, I think it was Tanya that was bringing up the topic of, well, should the ARPA money be an operating grant or a capital grant, or should it be general revenue? And I think it might actually end up being split, because we're using revenue replacement. Some of the money is revenue replacement, which is basically just saying we didn't make as much money as we should have made during COVID. And so we can reimburse ourselves and give ourselves some revenue. And that particular bucket of ARPA money can be spent on anything we want to spend it on. For instance, Hillsborough, city of Hillsborough, they categorize all of their ARPA money as revenue replacement. And then they just paid their police officers and firefighters with the money. And then that freed up general fund money that they used to help homeless and do some other programs. But the actual federal money just went to revenue replacement. So should that be general revenue, or is it a grant? It is an interesting question. So anyway, we'll have to think about that, because somebody's going to be doing the government wide sourcing, and we're going to have to segregate out how we spent our ARPA money, because some of our ARPA money went to revenue replacement, but most of it went to specific programs, and so that particular chunk of it probably should be broken up between capital and operating grants. And we have a way of figuring that particular piece of the puzzle out. So like anything that's in the grants fund, there's a table in SAP where there's a list of every grant that we have, and Sheila puts in there whether it's operating or capital. So we download that particular table and then classify all the grant revenues based on whatever Sheila said that particular grant should be. So given how busy she has been, she probably hasn't updated that in a while. So when we're doing the financial statements, we'll probably have to bug her to update that particular table. So post-employment benefits are those earned over workers' careers and are paid out only after employees leave active service. So for us, pension plan, our PERS and FPDNR, and OPEB are PERS and health insurance continuation implicit rate subsidy. And I always forget implicit rate subsidy for some reason. I think mainly because it doesn't really make sense to me why we're doing that. But basically what that is our retirees can buy health insurance for the same rate that an active employee can buys it for. So as a result, our health insurance rates are higher than they would be if it was only active employees. The PERS OPEB, well, it doesn't apply to any of us. I think it was like tier 1 employees. When they retired, PERS would help them pay for Medicare. I think it's like $250 a month or something towards Medicare. And let's see what this hyperlink takes us to. Okay, so that's all the Milliman's valuation stuff that Donna just went through, and that Kevin is going to have to review her journal entries because she just posted all those journal entries.
Lucky.
Yeah, again, it's a fun puzzle. And the liabilities went down dramatically this year. Seems like about 11 billion for PERS, mostly because PERS had a really good year, and they made like 20% on their investments last year, which means sometime soon all of us we'll be getting a statement from PERS telling us how much money is in our IAP accounts. So we all should be a lot richer here soon. So anyway, but that's another one we could go through in the future. I should probably add that to my list and do a little training on how to do the PERS and OPEB. But it gets complicated because everything has to be spread out across all the funds that have employees. And then we also share an account with Prosper Portland. So we have to allocate a portion out to Prosper Portland, and Michelle Whaley, who's their accounting person, then has to spread that number out across all the Prosper Portland funds. Pensions, OPEBs, and termination benefits. Termination benefits incentive for employees to voluntarily terminate active service. Settlement of involuntary termination of employee service. And termination benefits relate to current period, where pension and OPEB relate to prior periods. So we haven't done this in a few years. I don't think. I can't remember. But about the time we were moving out of the Portland building before the reconstruction, they were offering, I think, $25,000 to anybody that would retire. And we had a few people that took them up on it. Anyway, we had to do a no disclosure to talk about how much that was. And it wouldn't surprise me if it comes up again periodically when we're facing budget problems. They will make an offer like that, because then older, higher paid employees go away and they're replaced by younger, lower paid employees. So it makes a certain amount of financial sense. Pension and OPEB is distinguished between the plans administered by a trust or non-trusted pension. To be a trust, contributions and earnings are irrevocable. Assets can only be used to provide benefits, and assets are legally protected. So what we just kind of went through a little while ago. Now for OPEB, we have opted not to fund ours, so we don't have a trust fund. The county, Multnomah County, does have a trust fund, but their OPEB is different from ours, where ours is at implicit rate subsidy. They actually pay 100% of the health insurance costs for retirees up until Medicare age. And I think maybe TriMet does the same thing. So there are some funds that do have an OPEB trust, but we don't. So benefit types to define contribution, employee risk, defined benefit, employer risk. Our PERS is both. Our IAP is a defined contribution, and then the defined benefit is a portion that will pay us an amount every month after we retire. Types of plan are single employer, which for us is like FPD&R, and then a cost sharing plan, which for us is PERS. And then an agency plan. We don't have that in Oregon, but there are some states where basically every government in the and the state has their own separate pension plan, but it is all administered centrally by a state PERS. So where ours is a cost sharing plan where all the cities and counties and school districts are just pooled into one great big pool. The agency plans, everybody has their own separate plan, which I don't see how that is advantageous, because if you got a really small entity, you just do not have enough people to have an actuarially sound plan. So anyway, at Oregon, we don't have to deal with that. Other issues, numbers are based on actuarial studies. There are usually financial statements for trusted plans, and deferred inflows and outflows are used to smooth out changes and recognize them over a period of years, which when the standard was first written, I kind of thought was a good idea, but now I think it's an accounting nightmare. So, I mean, it'll show up this year, where although the liability for PERS went way down, that's not going to translate into a change in expenses, or as big of a change in expenses, because they will actually amortize that change over a 5-year period. So we'll just get a little bit every year. And then, but then that's happening for every prior year. Whatever the change was is amortizing over a 5-year period. So you got all these weird amortizations happening. So anyway, I think we're at a stopping point. Yeah, 21.
Do you know how to stop the recording, Ron?
Oh,
3 dots. and
Yeah, you'll
then-
click on more. It's the 3 dots.
At the very top.
Oh, when you get to Teams.
so gotta go back to Teams
Mm-hmm.
and the 3 dots.
3 dots.
And then the red button that says stop
the bottom.
recording.
There you go.